we're going to be talking about what Camarilla pivots are. Camarilla pivots are essentially a variation of the classic pivot point system. They're developed by Nick Stott, and the cool thing about them is that unlike traditional pivots, they're based on a mathematical relationship between price ranges. So they use fib ratios of the previous price action to kind of project a range forward. And I've just been watching these pivots for years now, and they're very responsive. For me, this is the way to go in terms of just easy pivots, in terms of just having them in an indicator when you're running through a billion charts and you don't have your own pivot super fine-tuned on the chart. This is a really good just place to start before you kind of fine-tune your levels or anything. We have some key differences that we should go over here. The standard pivot points, they're just going to use simple mathematical averages. So it's like the high plus the low plus the close divided by 3. And they generate 3 support and resistance levels typically. And, they're based on math, of course, but they're just kind of rudimentary. You won't notice as much fine-tuned interplay with these levels as you will with Camarilla levels, I've noticed. So I think why this is because these Camarilla pivots use Fibonacci ratios. So they're going to use 1.1 over 12, 1.1 over 6, 1.1 over 4, and 1.1 over 3. And this will generate 4 support and 4 resistance levels. Got your L1 through L4 for the low ones, the supports, and H1 to H4 for the resistances or the price targets up above. They generate these based on the previous day's range multiplied by these specific coefficients. So it still is operating on the same basic principles of calculation as any other pivot indicator. Essentially, we're trying to see on the chart where these breakpoints are, where the price is likely to go into mean reversion, or where price is potentially likely to break out.